All right, so the market hit 14 in a row, 14 Mondays to the upside in a row. That's quite the streak we haven't seen in a very, very long time. But it didn't necessarily do it on the greatest note. Of course, our hearts go out to anybody who's affected by this, especially innocents who are affected by what's going on with the invasion, the incursion of Israel by Hamas, and then, of course, any retribution. Anytime innocent people get impacted by that, it's not the best, of course, and a lot of the stories you hear about what's going on, and considering what's going to happen now as a result, it's not going to be a nice little peaceful ending, and most likely, and whether the markets go up or down on it, it really doesn't matter as to how people are impacted by it. So, again, we hope for the best. We hope for that it can come to as least violent of a resolution as possible, as soon as possible. But until then, as we're looking at it from a market standpoint, as we saw, there was a relatively decent reaction so far. Initial expected reaction, and then kind of maybe an unexpected reaction the rest of the day today, albeit on a quasi-holiday. So, and we've seen good Mondays turn into not so good the rest of the week. So really important to see how things react. And I'll kind of give you my expectation for what happens and why based off how the markets have done last Friday and then now today. So we'll take a look at that. And some of the bigger movers from an asset class standpoint, not your typical risk-on movers. So we'll break that down. And then our trade idea stock that's been bullish, but it's not really breaking down either. So we'll talk about how to trade that, considering the lack of a trend right now. So let's go ahead and get started. Today is Monday, October the 9th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before you get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog here, check out some of these other things over here on the right, including our Market Outlook live video. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. It opens up this tab. Hit that like button there. Again, we ask for this every day. It's a big deal for us. That's why we always ask. It helps us get our content out to all of our followers on these platforms. Our goal is to get 100 likes on Twitter. We got really close. I think this is the highest number I've gotten in a while. So thank you to those who click this day in and day out. Those who don't, you can do it right now while you're watching with 1 or 2 really easy clicks. All right, let's take a look at the S&P 500 with the market forecast indicator. We actually got a really good signal here today. We got both the momentum line up to extreme high. So the extreme on the high end would be above the 90th percentile, and the low end is below the 5th. So that's an extreme high. You notice it's the highest that the momentum line has gotten. Shoot, you have to go way back, like over here to March 3rd. Now, granted, March 3rd was also an intermediate decline, and we also got the momentum line above 90 and the near-term line above 80, and it failed, right? And then over here, we got it above 90 and the near-term line above 80, and it didn't fail. We got above 80. We had an intermediate decline here for a while. So it is a good signal. It's not 100%, it's not the end-all be-all signal, but it is good nonetheless. It's better not to have it, as you can see. So there's a good chance, right? This is a very, very good opportunity we have here to turn things around in the short term. We're still below the moving average. We still have dark pink shading and a red line. So we're not out of the woods. The intermediate line still, it's rising. It's still in the lower reversal zone. It hasn't crossed above market sentiment, which is in bearish territory. It makes it really easy for it to cross above market sentiment when it's in bearish territory. We just haven't done it yet. So, again, it's not surprising. Today is, the 14th Monday in a row that we've finished with a bullish move to the upside. So it's not surprising at all that we rallied today. The question is today the high of the week, or like most weeks here. Now, it wasn't the high of the week last week because it was for all week until Friday. But for the prior 2 weeks, it was the high of the week. It was the high of last week for most of the week. Is this the high of the week, right? Have we just now formed the high of the week here? Because again, this is, I mean, it's a Monday, but this time the high would be, I mean, you can see the near term line on the last Monday wasn't very high. You go back to the Monday before that, see that was October the 2nd, so the Monday before that was the 25th right there, and the near term line was not very high. It was actually in the lower reversal zone. You go back to the 18th where this high point was, and you can see the near term line had just barely peaked. But again, in the lower end of bearish territory. You go back to the 11th right here, another up day, and you can see the near term line had peaked again in bullish territory and rolled over. And again, you look at the 5th and the 4th, which was kind of, there was no 4th because of the Labor Day holiday, but the near term line had peaked there. So again, the near term line's peaking on a Monday or near a Monday. Is this the high of the week, right? And that's recent trend has been that that's the case, and we kind of need to break that trend like we did over here when we were bullish, where that's, we didn't do that. We want this to be the low of the week, Monday's low, to get a higher low point for the week and then be the low of the week and get a higher high point. We'll look at that here in just a minute. So that's a good, I mean, it's not the greatest signal, but it's better than nothing. Right, it's the Russell 2000 looks good, not as strong. The intermediate line is still easily in the reversal zone. The market sentiment line's a lot further into bearish territory, so definitely not out of the woods there. And then your Dow Jones Industrial Average, you can see again looking good. Strong short-term sentiment on both these lines. Got to get that intermediate line. We can't. This cannot be the high of the week, right? We need to. Ideally, we need this to be the low of the week. We didn't gap. Right, we actually gapped down, of course, with what happened over the weekend. So if we can get a runaway gap, some kind of good, strong gap with a good move to the upside overnight, that would be ideal sometime this week to kind of get us started. So that would be something to watch for. Finally, your NASDAQ 100, which has been the most bullish index, again, is close to getting us a bull tag, or a bear tag, light green shading and a yellow line. We actually do have light green shading and yellow line. We just didn't finish above the moving average. We're down. We have to finish above it. So that's still a possibility because depending upon whether the 30-day moving average moves higher tomorrow. And again, the intermediate line's actually a lot further. It's a lot higher. The near-term line got above the 90th percentile, so very strong short-term sentiment here. So very, very good opportunity that we can turn this ship around and really get it going to the upside. Let's take a look at the crossover chart, the weekly chart, and you can see again, it looks like a transition candle forming here. As of right now, it's actually a pretty decently bullish candle, but at the very least, it's a transition candle. So that's a good sign. It's a way higher low point, and it's a higher close as of right now. The Hakinyashi differential, the size of the body, is higher than its 3-day average. So that it's not positive yet, but at least it's higher than the 3-day average. So that's a good sign. The PPO is still falling, so we're not quite, again, out of the woods yet there. We don't have 3 red arrows now on any of the indexes. Even the Russell 2000's got a green arrow now on the MACD. So we don't have pink shade. We don't have pink shading or green shading. So we're in convergence mode right now, and we need to get to green shading, which means 3 green arrows. We have 2 on the S&P and the NASDAQ. We have 1 on the MACD for the diamonds and the Russell 2000. Looking at the 2-line versions, you can see we are at the very least now above the 17-day moving average, with the MACD above its moving average, still negative, but at least it's above its moving average. Stochastic still negative too. So, again, that's a pretty positive development there, getting above that 17-day. Of course, we'd have to get above the point of control, and you're not above the 17-day on the Russell. The Qs, on the other hand, remember, you're really close to getting above the 30-day. So you were above the 17-day on Friday, and now you're pretty close to getting above the 30 and the 50 and back above the point of control. We did get a pretty decent day of volume on the Qs, even though you didn't on spiders. And usually intermediate declines end with arrows down here with like 1.5 times the average volume. Of course, we haven't got that yet. So it makes you wonder again how likely it is that we're actually done with this move. It's probably more unlikely. You can see the DMI looks better, but it's not like we're not above 25 anymore on the negative, but we're not above 25 yet on the positive, right? So we haven't flipped that script yet. The Qs are the closest, as the negative has really fallen down to almost 20, but the positive can't get going, right? And of course, the Russell, which has been the most bearish, the ADX is very high. Your negative indicator is below the ADX, but again, nowhere near a reversal pattern on this. In fact, looking at the whole moving average, we do get a nice little reversal. The whole is finally green. We got the parabolic SAR flipping yesterday or Friday. The whole has turned green. You can see, the PPO is above its moving average as we're moving towards that 200-day, which is actually now red. And you got a pretty decent sized candle today, one of your bigger sized candles that we've had for a while, easily above 2.5%, which none of these got above 2.5%. So good little development there on the S&P. Of course, your Russell 2000 not quite there yet, and we're way below that 200-day hole. Again, when you look at this in context as to how far below that 200-day hole we are, it's a pretty decent level. Looking at spiders and how far below we got there, it got a lot further than it did during the banking crisis and during the last intermediate decline. So again, and if you look across my cursor all the way to the left, getting to these levels is more indicative of natural correction. I mean, we're well below that 200-day. It's going to be hard to get it turning green, which, you might briefly have it red during pullbacks, but it doesn't stay red for very long. We get right back above it pretty quick because we don't get very far below it like we have right now. So that's a consideration there. You look at the RSI and the CCI. Again, what we're looking for is that CCI to get above 100. And really clear that 100 so that, likely that we can stay up in this, up above 0 for a while. We're not above 50 yet on the RSI. We're not above 100 yet on the CCI. So as good as it looks, we're still not bullish yet. We're just not bearish either. You can see the weekly CCI is, this, if we're going to be really bullish and start a new long-term move to the upside, we got to get above 100 on the weekly. And of course, that hasn't happened yet because you got to get the daily above there first. Looking at the Ichimoku cloud, you can see we're not above the blue line yet. They still have a way negative rate of change. We're still below the cloud, so and the cloud hasn't crossed over yet. So there's no reversal here. We still have a bearish trend going. Intermediate trend strength on the S&P, still very mature strength on the Russell 2000, and we're still actually below the green. So again, this last 2 days, this goes to show how bearish we were. That's what it's taken just to get back to where we're actually not that bearish. I mean, not bullish, but we're just not that bearish either. The Keltner channel, the Bollinger Bandwidth is actually starting to roll over as we move back in the midpoint of the chart, but we haven't gotten into the upper half, much less the upper quartile, which would really change the trend. The momentum is yellow, so the momentum is waning, but again, we're not. There's been precedent for it to wane and then for it to re-engage and move lower. So we got to get into this upper half, ideally the upper quartile, to change this direction around a little bit. So that hasn't happened yet. Of course, not getting a new low in the last few days has brought the red line almost below 70. So that's the best development that we have going on right now. It's not below 70 yet, but once it does get below 70, then we are set up for a reversal. So a higher high, higher low, closing above Friday's high, right now closing above last week's high. So again, if this is last week's low and we end up getting a higher low and then a higher high, if this is the week's low, we end up getting a higher low and a higher high, great, right? If we end up getting back below this low and this ends up being the high of the week, which will actually be a higher high, but if we end up with a higher high and a slightly lower low, then we're just right back into the problem, right? We're new 4-week low point. So watch before in the next couple of days, before this gets below 70, watch to see, if we end up following through. Because if we can get above here, there's not a lot of resistance. We can move up higher. We can fill in this gap on the 21st, and we can kind of change this narrative of how bearish we've been. So really, really important next couple of days. I expect that this will probably be the high of the week, is my expectation. But we'll know really quickly if that's not the case, and we need to be aware of that. Obviously today with the holiday, you didn't have very low range. We were above average on the range, and you ended up with about average volume, but far less than what you saw on Friday. So pretty relatively low volume from that perspective. Again, looking at that 80 million, when you're looking at the averages, volume has really been taking off. We're a little bit below average today, and we'll keep an eye on that, or right around the average, today. Again, the ATR is rising still. We're above average on the rise today. We'll see if this ends up getting past this 1.25 points and gets up to 1.5, which is where you would expect it to get to. And again, as we mentioned before with the volume, the volatility hasn't quite made its move yet. We're still below 100 on the VIX. We didn't get above 100% relative to the VIX 3M. We are back. We were flirting with that 200-day moving average on the VIX. And MACD's kind of turning over, stochastics turning over. We're still flirting with that 200-day moving average. So we'll see if we can get back below here. Then again, this would be a very weak pullback and not quite a correction. In fact, you can see on the weekly market forecast earlier today we actually did have a bull tag here. And again, this would be the third week now that we have flirted with a bull tag only to finish the week without one. So usually that's unprecedented. Like, at least in the recent history, like going back 20 years, there hasn't been another instance where usually when you turn light pink shading, you do it with a bull tag. Over here, you didn't quite do that because it was red, right, when you had light pink shading. Over here, when you just turn light pink shading, you had a yellow line. Over here, you turn light pink shading, but by the time you got below the moving average, you were already red. Over here, you had light pink shading, you got the bull tag right at the beginning. Same thing there. So it's far more common when you get the light pink shading that you get below that you flirt with the moving average. So you never did get below it over here. Once you get below it, you get that bull tag on the first week. You can kind of see over here as well. You had 1 week, but you didn't ever get below the moving average on that week. And so this is kind of the first time where we have had light pink shading, right? We actually had light pink shading for multiple weeks. Then now it's been 3 weeks where we've actually traded below that line. So there was a bull tag, and we can't quite get it to stick. And you can see the intermediate line still falling, but hasn't crossed below market sentiment yet. And now your near-term line's flirting with getting above it. Remember that when you're between 20 and 80, that interaction between the near-term and the intermediate line is really important. So really important week here to see for us to turn this around or fail at turning it around, and then ultimately getting. And remember, the weeks we get the bull tags tend to be pretty decently down weeks, and we just haven't had one of those weeks yet. As you can see, we haven't had a 2% decline yet on the daily basis, and even more important than that, we haven't had a 3% or more decline. We came close at 2.92, but we haven't had a 3.3% decline with a bull tag yet on that weekly chart. So if we are going to get one, which I expect that we will, because I think we are in correction mode with what I've shown you today and before, that's coming, whether it's this week or next week. But if not, if we do get a bounce up here this week, if this is the week today and we get a new bounce up to new higher highs this week, filling in that gap from the 21st, especially if we can get a runaway gap involved sometime during the week, then we have a really good chance that this pullback now, not a correction, but just a pullback, is over. Correction on the Russell. We did actually have a correction on the Russell. We did make it actually below the 200-week moving average on the Russell. But it would just be a pullback on the S&P, and we'd have if it is, and we bounce, we have a good chance of getting back to new highs sooner rather than later. All right, if you take a look at what's driving this price action, of course, we all know what the big news was today that's driving this price action. Let's take a look at how the different asset classes perform. So give me 1 second to pull that up here. And you can see the big mover to the upside today was TLT. So the bond market was closed again for Columbus Day. So the actual bonds didn't trade, but the ETF did, right? This is a Obviously, this stock is traded on its own and meant to track actually 20 to 30 year collection of treasury bond yields and prices, actually prices. But again, since it's traded on its own on the exchange traded fund, it can actually trade even though the underlying's not trading. And it did. So it kind of gave us a preview. Like right now, the bond market is open and yields have really dropped pretty sharply on the 10-year and 2-year especially. 3-month is actually up, but the 2-year and 10-year have really dropped down. And again, that's a reflection of TLT rising at 2%. Now, obviously not surprising that commodities also rose. And it's also not surprising that gold also rose, even though the dollar was not down very much and was actually up most of the day with gold. So it's not surprising to see these three things. I mean, safety trades and then commodities with what's going on in the Middle East. Those are your biggest movers to the upside. International equities, again, usually gold doesn't do what. Usually gold rallies because of a weak dollar, but these two would rally with a weak dollar. And so they really underperformed, and again goes to show that they're more susceptible to that geopolitical risk in that area than the U.S. equity market is. U.S. equity market, again, QQQ, SPY, IWM, all pretty much behave the same. But you can also see a big drop here if I were to take a look at the ratio chart. So let's pull up the ratio chart here of the Qs relative to IWM. Give that a second to load up here, and while we're waiting for that, we'll pull up this chart as well, so we can take a look at the breadth here in just a second, because that was significant. And for that matter, let's bring up the RRG charts. Let's move that over there. But here, let's pull up the ratio chart. Okay, so you can see the Qs still up at above 2.1, so still very, very high levels for the Qs relative to IWM. MACD is back up again above 1, so very strong level in the MACD. The long-term PPO is rising. Your CCI was at a high level. The RSI is flirting with 70, so we are very, very high on this. But again, one of the other ratios that we look at typically has a strong correlation with the S&P is HYG relative to IEI, so kind of like a credit spread, so to speak. And yes, we rallied today. We closed lower, but we at least rallied off the open. And you can see we are still in this kind of bearish mode. The MACD is at negative levels below its moving average. The long-term PPO is falling. Bearish RSI, bearish CCI. So we are at bearish mode there. So that's makes you wonder a little bit about how bullish we really think we should be. If you look at the McClellan oscillator with the Qs outperforming IWM, the McClellan oscillator did turn slightly positive. So that's, again, this is kind of make or break now, because we've seen this turn slightly positive on some of these moves to the upside, only to fail, right? You get these 1-day moves up, 1 maybe 2-day moves up, and then we fail, right? We fail and we turn back down. So this wasn't that big of a move higher, and we're still below minus 500, which we haven't been since way over here. So we'll see if we end up failing on this. It's a really make or break right now, because if we can follow through and get above like 35, then we're fine. But if we fail, then we're not fine, as we've seen plenty of examples of a kind of a 1-day move to the upside. You also saw the 50-day number of stocks, another breadth indicator here. A pretty high level of breadth. It's not, again, we were up 34%, and you can see when you're up 40% or higher, and you're crossing the moving average is a very good sign. But to go up 40% or 34% only to get to the moving average, that's not a good sign, right? So we need to, we need to get through the moving average, and ideally we need to get through the moving average with a move at least up above 30%, right? So if we can get another day like the last 2 days and get through the moving average this time with that kind of move, to get, we've seen it have this kind of move to get to the moving average before, and it fails there, and we turn back down, and we are susceptible to that kind of move right now on the number of stocks above the 50. Here's the number of stocks above the 200. Again, not even to the moving average yet on that. It's back above 200, but not to the moving average. So we're not quite there yet. The number of highs to lows, you can see, has also not really gone in our favor yet either. Slightly above, after dropping back below minus 600, we're slightly above the moving average, but still at pretty decently negative levels. So the breadth still hasn't shown up. The money flow still hasn't reversed to the upside of at least what we want to see on this. We're still at, we're above 40, but we're not at, we're not here yet at negative levels. So we still have, we still needed more follow through than what we got. We got above this important Fibonacci retracement. Now we need to hold this, right? We can't get right back down, fake out, right? Get back below it. We need to hold this. So again, this cannot be the high of the week. If at all possible, this needs to be the low of the week. And we need to rally up to the upside there. Looking at some of these major assets, you can see DBC, look at that big move in commodity prices. Big jump higher there, especially in crude oils. We'll see here in a second. But, you can see how bearish. And we got to the 200-day moving average. We've bounced back up. Here's crude oil, right? Very important, of course. Did not get back above its 17 or 8 or 17 day for that matter. Though the MACD and stochastics looks like they might be kind of bouncing back up. Of course, the other big factor was TLT and how it performed, again, with the bond market closed, but TLT performing. But look, again, that's how big of a move it needed to get just back to the 8-day. Still hasn't gotten above the 17 yet, with the MACD closer crossing above its moving average. So we got a lot of arrows here, so we have a good chance that this could be the bottom. But we need more than just one day getting to the 8-day. We got to get through it, get it through the 17 with that bullish MACD. Then we'd feel good about the potential for TLT bottoming here. And then we'd have to hope that we stay in this inflationary environment where bonds and stocks move in the same direction, which has been the case, right? When you look at the correlation here of TLT with the stock market, it's been very strongly positive. If I were to zoom this out to the last 63 days, 3 months, you can see how strongly positive that is. Let me zoom out a little bit here so you can see some context. That's a very, very high level of positive correlation. Again, that's usually not the case, right? Stocks and bonds are usually not this positively correlated unless we are in a very strongly inflationary environment, and we either we are headed back towards some inflationary levels, and we'll find out just how much here this coming week, even though the expectations aren't very high. It's still pretty decently strong, but that's not a very high number. And you can see what the year over year is actually expected to come down a little bit here. So these aren't strong numbers, but this correlation, it's either this suggests that inflation will ramp back up just like it did back over here, and we started up with higher inflation for the rest of this period, or this is going to turn negative. If we're not in an inflationary environment, it's the other. If we're in a deflationary environment, then this is going to drop pretty rapidly, and you're going to see, again, bonds and stocks moving in opposite directions. And if bonds are rallying off this strong low point, then again, that would mean stocks faltering would be pretty bearish. So again, we're nowhere, we're not breaking out here on long-term bonds. So we're hardly, we just got to the 8-day. We got a long ways to go to even just get to the 8-week moving average with a MACD that might be turning higher. So we're not turning around necessarily. We're not, today or tomorrow, but you can see we might be forming a low point. And again, then it's a matter of what kind of inflationary environment or what kind of environment we are in, inflationary or deflationary. Looking how the sectors performed today, you can see the big, not surprising again, that your big mover today was energy, since crude oil and commodities did so well. Energy was up almost 3.5% today. You can see industrials, real estate, utilities was up today with the fallen yields. This is not your risk on type moves, right? All the other cyclical areas all kind of lag behind the markets. So not your typical risk on move, especially with energy rising. So again, another reason why it's like, we might not be nearly as bullish as we might think we are with how we performed here lately. All right, if you take a look at our trade of the day, I want to take a look at Federal Express, an industrial company here. Transports, one of the transports. You can see it's has been bullish, but then it's pretty much gone sideways since. A little bit of a bearish bias, small bearish bias. Intermediate line's falling. Still in the upper half of the chart, below its market sentiment line, which is also falling. Short-term sentiment's bearish, but not in bearish territory, but not really extreme. So nothing too major there. Looking at the weekly candles, we can see right now the Hakinyashi candles. It's a bearish candle, and we do have a red arrow, but nothing too. It's not the biggest candle. You can see if you look across, when we've been more bearish, especially when we've gotten into bearish correction levels, we haven't been. We've had a much bigger candle. So this is very, very small weekly candle. Looking at the 3 green arrows chart, you can see we do have 3 red arrows. Now I've had 3 red arrows here for a couple of days. Taking a look at the 2-line version of this chart, you can see that we are below the 30-day moving average and the 50, have been below the 50. The 8's crossing, the MACD's turning negative below its moving average. Stochastic's crossing in the lower half of the chart. So relatively bearish, again, bias, but nothing like major. Like we're not like breaking down hard. There is some support down here. You can see both the positive and negative indicators in the DMI are below 25. Looking at the RSI and the CCI, they're both relatively bearish, but not strongly bearish on either one of those. The Ichimoku cloud is also not showing us any trend really at all right now. There we go. So it's not showing any trend. We're actually at 0 on both these indicators. So there's no trend going whatsoever. And then looking at like the Bollinger Bands and the Keltner channels, you can see that that we are in the lower half of the bandwidth, below the moving average. You can see the bands have been inside the Keltner channels for a long time. So we don't have any kind of momentum going in either direction here. So when we do trades like that, I like to look at doing an iron condor spread. So if you take a look at the option sheet, not for October, we'll go out to November, selling the 20 delta. So we'll sell that 240, buy the 230. Come down here, sell the 270, buy the 280. So when you look at that trade, that's what we got. Oh, looks like I don't have it there anymore. Let's put it back up there. So depending upon where you get filled in at, if you analyze this trade and send those slices to break even, again, position sizing for a full position size, but since it's a $10 wide contract, we can only do one. And you end up with far less than $1,000, but you're getting $300 of reward for that. And if you look at where those break evens are onto the chart, you can see it's actually not a bad spot to have them in. When you look at especially where that support level is, you've got where the lower break even is, you've got the top of the value area, the point of control is at the very top of the value area, so really good support below that break even. And then again, if you're going to be threatening that break even on the upside, then you're going to be trending. So you don't, very obvious periods to either hold one of those break evens or be able to get out of it, knowing you don't want to be in it. Willing to lose $300 out of that $700, but knowing also that we can't lose, more than $700. So we've reduced risk with still a pretty decent probability and a pretty decent reward for that particular amount of risk. All right, well, that is it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow and like us on Twitter as well. Have a great rest of your Monday night, everybody, and we'll see you all next time.